Hey guys, it's Chris Mincolla with the Mincolla Group over at West USA Realty, doing our weekly housing update. I'm going to make this as quick as possible for you. So I'm going to start off by sharing my screen here and jump right in. So we have jobs numbers that came in hotter than expected at 130,000 jobs created. CPI inflation, uh, the rate of inflation rose 2.4%. They were expecting a higher number at somewhere between 2.5 to 2.7%. So that's good news. The rate of inflation, not that there's no inflation, but the rate of inflation is down. And when we look at, which means that's a good indicator for interest rates. But when we look at, well, we can look at this really quick. Well, no, let's not look at that yet. When we look at kind of some of the things that we all buy, food and everything under this administration, we see all these numbers are coming down. And when we see what was under the last administration, we see that those numbers were definitely elevated. So things are heading in the right direction. Um, and inflation during Trump's first year declined to 2.4% from the significantly faster rates under Biden, but still not down to 2% target, which comes from New Zealand, by the way. Like they know what an economy should look like. But the target, let alone the target of the average before the Biden administration of 1.8. So we're heading in the right direction. Nothing's perfect, but we're heading in the right direction. Doesn't happen overnight. When Jerome Powell convinced Congress to print $2.3 trillion in 2022, that's what you get. Too many dollars printed, chasing too few goods. Voila, you have inflation. So, for housing, let's take a look at what the 10-year Treasury did because this tells us where um, our mortgage rate should be because there should be historically um, about a 1.6 to 1.8 difference between the 10-year Treasury and the 30-year mortgage rate. And for this week, we see that this definitely took a dive on the inflation numbers. And everybody thought this would go up, which it did spike a little bit early on with the jobs report because it's a good jobs report. We have to be punished for that according to the way the last 10 or 20 years have gone. But that's where we have the 10-year Treasury and our mortgage rates today are almost at the year annual lows at 6.04%. Now, our local mortgage broker, just for your information, has rates on the 30-year conventional at 5.3 compared to the national average. FHA 5%, VA 5%. With qualified, mortgage, you get those rates from our mortgage broker. So a big difference in pricing. It's all about the fees that are charged. Usually you get a lot of junk fees in there. You hear a lot about foreclosures and stuff. I didn't pull up the chart, but basically foreclosures are down 1%. From the last report, we see that we're actually at pre-pandemic levels, lower than historical levels on foreclosures. On delinquencies, we're actually going to see that it's almost non-existent. Okay. So for the doom and gloomers out there that you may hear out there in the marketplace on the internet, on social media, a lot of that doom and gloom is just not happening. So taking a look at the national tracker here, mortgage application data did take a dive. The reason for some of these numbers is because of the snowstorm. Okay, all the economists, all the housing economists have been talking about this. So we expect that to snap back as far as mortgage application data. It's up 18% year over year overall, but we took a dive with the snowstorms. We saw a direct correlation with that, with people putting their money or putting their houses on the market nationally. That snowstorm did affect that, along with mortgage application data and people out there actually purchasing homes. The hot spots right now for affordability are the Midwest, and you've got some definitely in the South. If you're a buyer, it's a good place to be down in Southern Florida. Northeast definitely has an inventory issue right now because of the snowstorms, and they kind of had an inventory issue running into all this too because they can't build as much as we can out here in the West. So pretty simple stuff. The national single family housing inventory, again, a little flat this week, coming in at 687,000. But right now, overall, we're right around where we want to be for a balanced market. We're just over 4 months supply. And overall, when you take into consideration the lots that are available coming on online, and everything, we're over last year, so more housing inventory than last year, which is good at this same time. And when you take into consideration properties that have gone under contract too, which will be kind of in a lot of the readings out there, you'll see that we're actually ahead of where we were. So we've got more inventory overall, even with the snowstorms. Jobless claims up a little bit at 213,000. And a lot of people don't know this, but about 1.5 million, 2 million people lose their jobs every month. Every month. I know that's crazy, sounds crazy. Not all of them apply for unemployment, though. So, national single family new listings. Right now, we are still elevated from last year at this time. So, not by a lot, but about 3,000, 4,000 homes. Percent of properties with recent price reductions. Right now, we're at 33.6. Last year, we were at about 32.23. So a little bit lower for this year. Pending sales, we're definitely, if I can get the right thing here, sometimes these things are kind of hard to get lined up with here, but we're definitely climbing compared to previous years and last year. Spread not by much, but the spreads between, this is the big thing right here. And this is why we saw those treasuries that were bought by Fannie and Freddie, $200 billion in treasuries a couple weeks back. This is keeping the spreads between the 10-year and the 30-year in line. So we can see the spread is much lower at 1.84%. That's right in range of where we want to be at the high end or just a little bit above it, but right where we want to be. And we see there's a whole article here on Housing Wire. I won't bore you with it, but impact of the winter weather definitely having an impact. Okay. So when we get into the Phoenix numbers, right now we're at 91 days closed on market. We're at 6.81 months supply. Technically, that would put us in a buyer's market, but we're going to see an absorption rates down a little bit. We're going to see in the numbers here how things are forward looking, where we're headed. Average list price, 788. Average sales price, 661. 97.06% list to sales price ratio. So sellers are giving up almost 3%. Active is up 1.9%. Pendings are up. This is what I wanted to point out. The actives are up, pendings are up. We're going to see that those two numbers climb. Closed units are still down week to week. But again, coming out of the holidays, people got to, find the homes they're looking for, go under contract. It takes 30, 45 days, sometimes longer for people to close on a property, but usually it's about 30 to 45 days. So this number is going to change over the next month or so, going into the next couple of months. We see all the price points here. The changes are all positive in the number of units, and the greatest percentage is found between that 400 to 600,000 range at 66.61%. 600 to a million, 18.79%, and over 1 million, 14.5%. So there's a quick look at the numbers there. Look for those numbers of pendings and actives to go up as we head into the busy season. People file their taxes, all that good stuff. Right now, looking at today at the real time, single family residential homes, we've got little over 18,000, 18,005. And all property types, we've got 25,267 total. The Cromford Market Index gives us an idea of what's going on in the market. Below 90 is a buyer's market, over 110 is the seller's market, 100 being totally balanced. Right now, technically, we're in a buyer's market, but we're starting to see, as I had mentioned before, a couple of weeks back, over the last week or two, we're starting to see multiple offers on properties. So properties are starting to go under contract a little bit faster in real time. I'll show you that in just a second, what that looks like. Here's our supply. We're almost 2% below normal supply or balanced supply, and demand is down about 16%. But if we look at the real-time numbers of what is active and what is actively for sale and what is under contract, we're at 34 on the contract ratio. So what's under contract, what's active. And if you look all the way across here, it's hard to see, but if you look all the way across here through last year, that was kind of that number is actually higher than all the other months, um, going all the way back into the last year. So as we kind of break out of this doldrum with these lower rates, it's starting to spur more buyer activity. So we're gonna obviously track this every week, but 34% puts us, right now into a warmer market, not a hot market, but a warmer market heading towards balance in real time. Here's kind of the hot areas. You got Gilbert 85234 and Gilbert 85296. Also Mesa 85203 zip code, and in the Phoenix area 85024. Those are all hot areas right now. And we're starting to see a lot of the balance to warm coming out of the cold areas that we had, up until this point here that we're heading into right now. Things really changed when rates began to drop last year, and now we're nationally over a whole percentage point lower because those spreads between the 10-year Treasury and the 30-year mortgage are better. And we're going to see that split between the 10-year and the 30-year remain in a healthy range because of the fact that the economy's, not perfect, but it's definitely getting better. And we're starting to also see that, that money that they put into those mortgage-backed securities is going to keep things in check until we get the new Fed chair and we get some better dovish action. We're already behind the curve. We should be at a neutral to an accommodative policy already, which these numbers on the jobs numbers, are showing some good news there. But on the inflation, it's showing us that we're behind the curve, and those numbers are actually, if you dig into them, the shelter costs are finally starting to show up in there. They only went up like 0.2%. So that's why we're starting to see those numbers trickle in that we've been talking about, that the shelter costs have been going down over the last 26 months, as far as how they gauge that in owner's equivalent rent. So guys, if you have any questions at all about your home value, you're looking to purchase a property, feel free to reach out anytime. And that's it. That's all I have for you this week. Thanks.